Hello and welcome. You're watching Managing Money with Moneycontrol. I'm Sakshi Batra. Last week, we spoke about the basics of debt funds. Now, debt funds are surrounded with quite a lot of bad news. Just last week, DHFL delayed its payments and many debt funds' NAVs also went down. Experts believe that the pain in debt market is still there. At the same time, if you see, the RBI also reduced interest rates last week. Now, this is good news for the debt funds. So, there is good news and there is bad news. Moneycontrol's personal finance editor Kayezad Adajania now joins in to help us understand what does it mean and how to make the most of it. Thanks a lot, Kayezad, for joining in. Now, let us start by asking you, we already have the good news. RBI has reduced the interest rates last week. What does it really mean for the debt fund investors?
Hi Sakshi. So yeah, you're right. The Reserve Bank of India reduced its interest rate last week. It was the third successive interest rate cut so far this year. Now, this is obviously good news for debt fund investors because interest rates and the prices of debt securities in which the debt funds invest in, they move in opposite directions. So if the interest rates go up, your debt funds go down. If the interest rates go down, then the NAVs of the debt funds go up. So which is why a fall in interest rate obviously is a good news, because then that is a signal that your debt fund NAVs are either bound to go up or would have already gone up by now. The other piece of good news is actually the language of the RBI governor this year, when he said that the stance, the policy, the monetary policy stance has been changed from neutral to accommodative. Now what this means is that when the stance earlier was neutral, that means interest rates, future interest rates could have either gone up or could have gone down, either ways. But when the stance is accommodative in the monetary policy, it means that there is no chance of interest rates going up in the near future, as the RBI governor himself elaborated. In fact, there are more and more chances of interest rates going down also in the future. So this all put together means good news for debt fund investors, and it's a good time for you to invest in debt funds.
Well, that's good news. So what type of debt funds should we really invest in now?
So, there's no one-size-fits-all policy, Sakshi. I would suggest that, you need to sit with the financial planner, your financial planner or your distributor, and figure out actually which type of debt fund is best suited for you and why you are saving the money in a debt fund and what you want to get out of it. But broadly speaking, okay, there are short tenure debt funds and there are long tenure debt funds. There are debt funds that invest in high quality assets. There are debt funds that actually are more risk prone and they invest in slightly low quality assets that take more risk but have the propensity to give more returns also. So you need to ascertain why you want to invest in debt funds, how long you want to invest in debt funds, and then decide which debt fund you want to pick. Like for example, if you are a conservative investor and if you're not very comfortable in taking risks, then you invest in a liquid fund, you invest in a very high grade corporate bond fund or a short term bond fund. Avoid those funds in these markets, especially that take a lot of credit risk. If the fund manager or this fund does not have a good track record of managing the risk, then your money could be in problem. So these are some of the basic principles that you need to keep in mind when you pick out the debt fund. But as I said, you need to sit with your advisor and figure out actually which type of debt fund is best suited to your goals.
Great. Now let's try and break down the bad news. Now what happens if you are caught in a fund that actually holds a debt scrip that has defaulted?
Yes, that's been happening a lot in the past 6-7 months with the ILFS fiasco, the SL Group fiasco, the ADAG fiasco, and last time in the last week, the DHFL fiasco also happened. So there's a good chance that one or two debt funds here and there that you may have in your portfolio may have been caught holding these kind of scrips. Now what happens was that your debt fund's NAV is arrived at by valuing the underlying scrips that your fund invests in. Now what happens is, when there is a default or when the underlying company in which your debt fund has invested in fails to repay its interest or repay back its principal to the debt fund, that means it's a default. In this case, the value of that particular security falls, and if the value of that security falls, the NAV of your debt fund also falls. So, this is what happens when you are caught in one of the funds that is invested in these scrips. But the important point to note is that you need to hold on to your fund, because eventually when the underlying company pays the money back to your debt fund, the money gets added back to your debt fund's NAV and your NAV goes up again. So you need to stay invested in throughout this cycle to ensure that you don't just redeem in panic and take the loss on your books forever.
So, Kayezad, would you say it is important to wait it out and not redeem in panic?
That's right, Sakshi. You need to wait out and not redeem in panic because, there could be a default in the interim. Your underlying company in which the debt fund, as I said, would have invested in, may not pay the interest or the principal for now. But there is always a recovery process that's set in mechanism. Once the money actually comes back in future, there is a good chance that the money can come back in future. At least 60%, 70%, 80% recovery can happen. You need to stay invested in the fund throughout that time to be able to take that recovery. There are mechanisms that the regulator has put into place, like side pocketing, which means that the infected portion of your portfolio is carved out and that is ring fenced. Okay, so no amount of inflows and outflows are allowed in that particular portion of your portfolio, which means that there are mechanisms in place that sort of are put in place to sort of treat that infection, and you need to wait out till the underlying money comes back and gets added back to the fund. You don't know whether your company is going to pay back or not, but to know that for sure, you at least need to stay invested throughout the cycle.
And lastly, Kayezad, how do you know if your debt fund is really caught in this storm or not?
You'll receive a communication, Sakshi, from your fund house if that is the case. Obviously, if you are monitoring the NAVs, you would notice sometime a very sharp fall, like last week when DHFL defaulted. Some funds' NAVs fell by as much as 40% or 50% in a single day. So, when there is such a sharp fall in your NAV in a day, you know that there is something wrong. So, you have to get in touch with your, either you can get in touch with your fund house or you can get in touch with your distributor or advisor to find out more as to what has happened. Subsequently, they would also get in touch with you, especially your fund house, to tell you that, this problem has happened. We're trying to solve this problem, so hold on for a little while. In the interim, yes, your funds are running into losses, but we are trying our best to sort of recover their money. So your fund house will also communicate with you. You also need to communicate with your distributors and advisors, as I said before, to understand the root cause of the problem, to understand the severity of the problem, and to understand what your fund house is doing to recover this money back. So the communication between you and your fund house and your distributor advisor during these troubled times is very important.
Thanks a lot, Kayezad, for sharing with us all that very important information with all our viewers. And with that, it's a wrap here. Many thanks for watching.